Let's create a budget. Let's get out of debt. Let's build wealth. Guys, welcome back to the channel. So in this video, we're going to continue with part 2 of velocity banking, why it works. So in the first video, we went over how it works. Let's do a quick recap on that. So all income coming into the house will go into your checking account. So you get paid from work, you have direct deposit, all the income will go into your checking account. You would then transfer it to the line of credit. So when I say line of credit, this is referring to whether you're using a credit card, whether you're using a personal line of credit, or whether you're using a HELOC. Whatever that tool that you're using, you would transfer that income into the line of credit. You know, if you watch the videos on creating a budget, you would already, you wouldn't leave your account at zero. You would have that 1 month build up into it, and it would just flow into that checking account and right back out into the line of credit. Then your bills will come out. So slowly over through the month, your bills will come out. You would transfer it back to your checking account, and then you would pay the bills as they're due. So only the bills would come out, so that cash flow, whatever your cash flow is, it will stay into that line of credit. And the more and more, as the months go on, as you pay your bills, that cash flow will build up and up and up, which will eventually pay that line of credit back off. Once it's paid off, the process would then repeat itself. And this will happen over and over again until you're out of debt. So one more thing before we move on to why velocity banking works. The more and more I talk to people, there's a lot of them that get confused on this part of it. So they were only putting their cash flow into the line of credit. So after they chunked, they would pay their bills and stuff, and then they would put the cash flow into the line of credit. So let's look at this. So you have your numbers, and then you have your income, you have your expenses, and then you have your cash flow. So let's say you have a $50,000 line of credit and you chunked $35,000. So where people get confused is they put the $5,000 into their cash flow. With velocity banking, all of your income goes into the line of credit. So in this scenario, you would put your income, $25,000, into the line of credit. You would then take out bills as you needed to pay them over the month, which will bring the line of credit back up, but you won't pay interest for those days that the income is sitting in there. So basically, all that income goes in there, because when you get paid, that if you get paid bi-weekly and it's the first of the month, most of those bills are not going to be due yet. So we're basically just parking that income in the line of credit and letting it sit there. So as it sits there, that's less, it drops that balance way below, and that's less you will be paying. So this was kind of an introduction. So now let's look at how velocity banking works, or why it works, actually. So this right here is a simulation of a car schedule, amortized schedule on a car. So let's look at an example. We'll do a $15,000 for 5 years or 60 months, and we'll just do a 5% interest rate. So the payment on this car will be $279.65. So $279.65, if we paid it for 60 months or 5 years, that last payment will be a little bit less, but we'll pay a total of $1,778.68 in interest. And what velocity banking it's really it's a numbers game, right? Because if you look at the interest you're paying $56 a month in that first month. So what velocity banking is doing is, let's say, like in the previous video's example, let's say we had a personal line of credit of, say, $5,000. Okay, so this is going to simulate a line of credit. So let's say we have the line of credit for $5,000. So we're going to chunk that $5,000 to the principal on the car. So when we chunk $5,000, right, your total interest $1,778.68 is what we're paying. So when we make that payment, that $5,000 chunk, it's going to instantly, that first month, the total interest on the total of this loan is going to be $779.04. So you're saving $1,000 instantly that first month just by having that line of credit and paying this car off in a different way. So the reason why it works is because you're knocking that, you're cutting off that interest in the beginning months of an amortized loan. So if we go back to this line of credit, right? So now we owe on this line of credit, and where that point, that fact where people were getting confused, that if you have cash flow of $500 and you make that payment of $500 or cash flow 500, right? That first month, you're going to be paying $34.65 in interest. Now, let's look at the way a line of credit works. So you basically you'll have like C1, which is your checking account, S1, which is your savings account. And if you have $500 and you just want to transfer from your checking to your savings, you'll move it over. It's just that simple. And then when you have a line of credit, once you obtain a line of credit, it'll basically be like a L1. It works the same way. You could transfer between this line of credit to the checking account, back to the savings account, back and forth. It doesn't matter how you do it. It's just as easy as transferring from a checking account to a savings account. And the way interest works on a line of credit is it compounds daily. So if you get paid your $5,000, right, and you don't have, your bills probably is not due, let's say, mortgage can probably not be paid until the 5th, and then some of the other bills aren't due to the 16th. So all it is where you're parking that cash. So if you just send your cash flow here, right, you're going to pay $34 in interest for that month. But if you transfer from your checking here and put the whole $5,000 in here, right, look, you only pay $1.23. And that's why velocity banking works. It's about parking your cash. Now, at $5,000, it's sitting in here. And then, if your mortgage, your rent's due, let's say it's $1,500, you're going to withdraw back out of the line of credit $1,500 to take care of that bill. And then you're going to get charged 74 cents that month. And then let's say that the rest of your bills, you have a car payment or something like that. Well, we're chunked to the car, but if you have your electric bill coming out on the 20th and it's going to be, $120, and then it goes up from there. But you see, even then it's $21. So depending on, by letting your entire income sit in here, and then that next month, right, your income is going to sit back in here again, right? I mean, it's going to, well, actually the rest of your bills would have came out for that month, and then it's going to slowly, see how the interest, it's just less and less. So that is why velocity banking works. I will do a video where we go in depth, do like a 12-month study on it, but I just kind of wanted to show you guys how or why it works. So, and how you're able to have all your income come into the line of credit first. It sits in this line of credit every single day until you need it. So either that morning when that bill is due, you'll transfer. It's instant. When you transfer from your line of credit to your checking account, you'll transfer it, and then you'll pay that bill, and you leave the rest will just keep sitting in here for as long as possible, because the longer it sits in here, the less and less you're paying. See that if it sits there that first few days, you're not paying any interest until the day is actually due. And if you watch the videos on creating a budget, you already have your checking account at a certain amount, you can technically let this sit in here all the way up until the end of that month and then do the transfer. So it's all velocity banking is a numbers game. It's an interest rate and a numbers game. And then slowly, your 500 would actually stay in here total. Let's make this easier. That 500. And then, so slowly as that 500 stays in there, it'll eventually bring this back to 5,000 available. And then you would chunk that back onto the car and you'll rinse and repeat. So that's kind of, I just want to do a quick kind of overview on why it works. You saw how it works in the last video. This is why it works. You're parking cash. It's basically where you're parking that cash until you need it. And if you're parking it into a line of credit, the longer it stays in that line of credit until you actually need it, the less interest you're going to pay. And then once, if this payment, if you were able to keep it all the way down and then you need to take out the cash, if you already have it built up, you take out what you need, 4,500, right? You're only going to pay 222 in interest. And then when you get paid again, it's going to go right back in there and then cut off the interest again. So that's kind of the mechanics of it. I wanted to show you guys a little bit on how it works so you can get a better understanding. And the more and more you do this, the more and more you'll understand how it works. And it works the same way with the credit card. Credit card is a simple interest, kind of like this. It sits on a daily balance. And as you transfer in and out of a credit card, it works the same way. So guys, I hope this helped explain it a little bit. Don't forget to subscribe and hit the thumbs up button. It helps the YouTube algorithm push this out to more and more people. And if you are subscribed, don't forget to hit the notification bell. It will alert you every time I post a video. I do post a video every 3 days, so you can look for it as a regular schedule. And if you found value, guys, again, hit the thumbs up and I'll see you on the next one.